Good afternoon, everybody. For those that do not know me, I am Chris Seveny with Seveny Investments, and today I wanted to record a video, talk about the first quarter update for 2023 that we issued to investors, and talk about also what we're seeing forecasting for quarter number 2 of this year. For many people out there who, follow economics, the news, and the real estate markets, the news is starting to get a little gloomy in real estate. We have, commercial, multifamily, really taking, negative downturns. Single family is still kind of holding a little bit strong, but we anticipate some softening in those markets. Really, it's the banks leading the charge with the liquidity issues that we potentially see. I don't like to, say this is a good thing for, distressed debt investors, but it absolutely will lead to additional opportunity, and we're in a much better position, I believe, than multifamily syndicators and people who own some of this commercial office, especially those who have short-term variable rate financing. We're going to see probably a lot of assets start coming on the market. We're already seeing some banks start to unload some of their debt that has near-term maturity dates because of the anticipation of it going into default. So, as we mentioned in the report, again, in that first quarter, we highlighted some of what we're seeing in this market. As mentioned, we saw over $300 million in assets come across our desk last quarter. That is, a significant figure. Previously, last year, except for Q4 of last year, we didn't see that type of volume. And in this first quarter already, we've already seen over $100 million of assets, and we're just over a week into this next quarter. So we clearly are starting to see that uptick in distressed debt and debt coming back on the secondary markets because of, some of these other liquidity crunches. Overall, as we mentioned in the first quarter, it was, for us, we thought it was a very good quarter. We had, some loans paid off. We sold some loans. So overall, we are very happy with the performance of the fund to date. If people have specific questions, feel free to always reach out to our investor relations team or join us on one of our monthly webinars that we issue. A lot of them recently have been kind of Ask Us Anything, and we're open to talk about, the fund and what we see on things. So hope, we can answer those types of questions. If people are interested in questions on our case studies, we're also happy to answer any of those. But, so last quarter, we thought went extremely well. The next quarter, or what we're seeing already, like I said, we're starting to see a lot of assets come on the market. We're also, because of the number of assets coming on the market, sellers are starting to get a little more aggressive in lowering some of the costs that they're asking for. A year ago, there were assets that were buying, bought an asset today or recently, let's say we paid 60 cents on the dollar. A year ago, that would have been 75 cents on the dollar on some of this distressed debt. Now, why is that the case? Again, it's a supply and demand issue. A lot of these larger funds are starting to have an inordinate supply of distressed debt. They only have so many people to manage it. They're looking to get that off of their books. The banks are going to have similar issues where basically some of these lower value loans that go in default, the banks are going to want to have to move those off their books to not carry them on their balance sheet. So we fully expect to be very busy over next quarter. We do not see any type of inventory shortage, inventory supply, or significant increase in the pricing of assets. For many, and we'll talk about non-performing. So when people ask, well, how does that impact if we go to look to sell assets? Well, typically, we manage through our non-performing assets. So we typically will, if we sell assets, sell them on the performing side of things. The performing front is still performing very well. That market is much more stable for what investors look for on returns on that side of things. So, we haven't seen any significant changes on the performing loan portfolios and where those are pricing. We're just starting to see it on some of the non-performing stuff. From an asset management side of things, one of the things we'll mention as well that we're starting to see, which is positive, is states are gearing up again for new programs for distressed borrowers. For example, state of Maine has a $50 million program that they can give up to $50,000 per defaulted loan. So we have a loan in Maine. We're going to the state right now to see if we can get $50,000 to pay down some of the defaulted debt. Of course, if we can get $50,000 in a payment from the state on the borrower's behalf, that is going to be a huge score for us and for you as investors on the fund if we can get that. And other states are starting to roll out some of those programs. So it'll be very interesting to see as defaulted debt increase, what does the government do? Previously, 15 years ago, I think many people would say they bailed out the banks. There were some programs for homeowners. Now, if we run into the situation again, are they going to bail out the banks, or are they going to try and help the homeowners to keep them in their home? As investors, if they can work with the homeowners to get the funds back to us, of course, that would be the better outcome. That's not something that we model or bank on. I just want to be clear about that. But we're starting to see more of those programs, which is going to be beneficial for us. The other component that we're seeing from the asset management side is the courts are a little more freed up. Some of that backlog that they've have gotten through. So being able to work some of these defaulted cases to get them moved along, because like any type of I'll call it disagreement or any type of I'll use the term lawsuit, but any type of involvement like this, things usually don't get settled to the last second. So being able to push these through allows for a faster resolution, which is better for everybody involved. So those are, again, some of the high level. We're still on the investor relations side. Lauren and her team are doing a great job, working with you as investors. Also, we're continuing to raise additional funds, within the portfolio to allow us to continue to buy more assets, along with any of the assets that do get disposed of, to continue to recycle those. So we're expecting, a very busy quarter. We'll continue to provide investors updates every quarter. And as always, if you have any questions, feel free to reach out. We're happy to always answer your questions, or feel free to join us on one of our monthly webinars. We have those typically, the second Thursday of the month. And lately they've been, open forums to ask questions about the fund, the offering, what we do. If you want additional information on kind of note investing or a little deeper dive, feel free to reach out. We can provide you lots of resources to continue and further educate you. So thank you all for watching this video. Hope everybody is having a good spring so far, and look forward to hearing from you and also providing more content and videos for you with updates on the fund. So thank you all.